think the revenue architecture framework and the subsequent additions that they've already made and how that will continue to evolve will be the gold standard for how B2B companies, recurring revenue businesses, operate and run their go-to-market like a revenue factory. I'm certain of that. The last time there was a big change like that was the MQL demand waterfall. You could argue that ABM was another change, but I don't even think it was that meaningful. So I think there's a big shift happening. I think that a lot of companies are moving in this direction because it just logically makes sense. Then you add in the pressure on the economy and how unit economics really matter, and the growth at all costs era is now over. And there's just so many dynamics that are pushing the market into this direction. So I'm excited to see how it plays out. Welcome, everyone. Good to have you here.
Hello, everyone.
Good to see everyone. This time we got this. Jacco's going to be sharing some slides through the speaker view, so I can't see everybody in a bunch of detail on camera, but great to have you all here. I'm very excited about this event. We've been talking about the Revenue Factory for months now after I was introduced to Jacco's work. I actually met Jacco in 2019 when I was an early entrepreneur. I had no employees and basically no customers, and he shared some of the insights and wisdom about how he was able to grow his business winning by design. I found that very helpful that he would take the time out of his day to help me out. And I'll remember that for a long time. And now all of a sudden we're coming back together a little bit. We announced the partnership with Winning by Design last week, which I'm super excited about. I think the revenue architecture framework and the subsequent additions that they've already made and how that will continue to evolve will be the gold standard for how B2B companies, recurring revenue businesses, operate and run their go-to-market like a revenue factory. I'm certain of that. The last time there was a big change like that was the MQL demand waterfall. You could argue that ABM was another change, but I don't even think it was that meaningful. So I think there's a big shift happening. I think that a lot of companies are moving in this direction because it just logically makes sense. Then you add in the pressure on the economy and how unit economics really matter, and the growth at all costs era is now over. And there's just so many dynamics that are pushing the market into this direction. So I'm excited to see how it plays out. We brought Jacco onto the show, the founder at Winning by Design, the author of Revenue Architecture, and I'm sure many other accomplishments, to go through specifically running your go-to-market as a revenue factory. We've covered some of the key points, like the 12 revenue breakpoints to $1 billion ARR. We've talked a lot about go-to-market efficiency. Jacco is going to kind of bring this whole concept together with the concept of production lines and some other details, so people can really internalize and understand this. And I think we'll spend even more time on go-to-market efficiency and some of the topics that the audience here is familiar with. So with all that, Jacco, really excited to have you. I know people are going to learn a ton from this episode, and looking forward to getting into it.
Thank you for having me. Great to see you again, Charlie, David, Jamie, Tracy, wherever you are, Nancy, Chu, I see you over there. Michael, nice to meet you. Kelsey, Adam, Diego, Nick, and everybody else I've missed there. Nice to see you all. Nice to meet you in person. Thank you, Sydney and Carolyn, for setting us up today. Really appreciate it. I know it's never easy on getting all this kicked off. So thank you for all the invites and how that all goes. Much appreciated. Chris, what are we doing today? Tell me, where are we going to start this thing?
We're talking about running your go-to-market as a revenue factory. And so you probably have like a good talk track that starts at the beginning, helps people go along. I know the production line concept is going to be really useful for people, but maybe you have some other context to set it up.
Yeah, I'd love to ask for all of you. Diego, Charlie, David, Evan, and I'm going down the list. Kelsey, okay, I'm typing in the question of GTM. Type in the chat. What do you think the role is of GTM? What does GTM do? What is the main thing that GTM do? Deliver customer impact. Charlie, well-trained. Sounds like a Winning by Design certified person. Not necessarily Kooij. Yeah, recurring impact. Thank you. Grow and retain revenue. Fantastic. Love that too. Bring a product to market. Love that. Help customers drive sales. All good. Efficiency. Again, fantastic. Produce. Okay. All these alignment structure. Okay. All these are good. Why are we doing this for? Why are all of you, us, why are Chris and I running a business on this? Why are we all doing this? Essentially, folks, what you see is we are turning $1 million asset into $1 billion asset. That is what we do. And, like every day when we do that, from $1 million to $1 billion, we turn an asset that is like $200,000, $300,000 revenue, worth a couple of $1 million. And then within a few years, that product needs to be valued in the hundreds, preferably billions of dollars, right? Winning by Design, we just worked with a company that went IPO like 3 weeks ago, $4.7 billion, right? But we help with that. How do you turn that $1 million asset into a $1 billion asset? That's what the question is. Now, what I'm going to go, I'm going to share some of these experiences. Chris, feel free to stop me, to ping me, to see something on the chat that you want to see answered. You just like control me, guide me, and so on and so forth.
Yeah, I'm going to let you roll with it for now. Keep it going. Love it.
Got it. Okay. Now, many of you know us already. We help over 1,000 companies. We have about 100+ companies that we have helped that are over $100 million ARR. There are about 1,200. There are 1,200 companies there. And currently, there are about 170-ish public SaaS companies we're tracking on an ongoing basis through our content with David Spitz, our relationship with David Spitz. We're tracking about 80, 82. And so we're helping about like Winning by Design helps about 1 in 5. So that's where all this knowledge comes from, right? I'll give you a quick heads up. How many, help me in here again, like Diego and Nick, you're on the, type in, how many IPOs were there, what do you think, in 2021? How many IPOs in 2021?
I'm going to guess 12.
Okay, 2021, not a bad guess. On 15, 25. Okay, look at this. Thank you. 32. Okay, so that's 20. There was about 27 or 29, something like this. So everybody's in the ballpark. So how many companies do you think by the end of 2025, how many IPO slots are available? Give me an idea. How many IPO slots do you folks think is available over the next, give or take, 18 months? Now, here's the big question. There are 1,200 companies geared to go IPO. There are 20 slots. I mean, if you ever wanted to be part of a Survivor game or what is it, that's the game. There's 1,200 companies that are geared to go IPO over the past years already. Didn't happen. And there's about, like 25 slots. And I verified this with Dave Spitz, who does this for a living, right? And 25, he said, would be high. So 20 to 25, right? Yeah, that's worse than the roulette. That's exactly right. I love that take. That is the thought. And what I'm going to demonstrate to you today, and what I'm going to talk to you about today, is that historically, we thought product would do the trick. Product will make the thing work. Well, with 1,200 companies, yes, great product will succeed. But if you don't have a good go-to-market, you're not going to succeed in that. And what you'll see here is that as a company matures from one stage to another, you see the significant increase in importance that the GTM has to play. Now, is product always success? Is always needed? Absolutely. Without a great product, GTM doesn't even matter, right? So don't get me wrong. We should always understand that great product is among the, at Maslow level 1, right? It's the first thing you must have is great product. But assuming that if you have $200, $300 million, you kind of have to have a decent product already. So assume that everybody in that realm has approximately the same product. That what it means is you got to get your go-to-market, right? That go-to-market, and I'll step through. I'm going to flash some of these things through. You've seen these before. This is nothing new. But since the market crashed, since that occurred, since that market reset, we have experienced something significant. Now, what I want you to experience is that reset equals, let's call it puberty. So SaaS is not dead. SaaS is simply maturing out of puberty. And how it doesn't matter, puberty, there's some good and there's some bad. We have some good things with how many companies we have. We have some bad things by grow at all costs. It is fine. We're simply maturing and we're now outgrowing the puberty phase. And as we outgrow that puberty phase, we now need to go into a more cost-efficient, data-driven GTM approach, right? Now, since that crash happened, many of you have seen these metrics before, but since that crash happens, folks, the growth rate is halved. The cost of growth is nearly doubled. The NRR, which is part of the growth rate, but independently, it is halved because we measure NRR from 100%. So technically, it went from 21% to 8%, nearly 1/3, and still falling, right? All this is happening right now. Now what you'll see if I go back, the growth rate is stabilizing. We see that, but the cost of growth is not yet. Neither is the decline in NRR. So we see that the cost of growth still is going up and the NR is still going down. And that tells you what the problem is. We had the market reset. Since then, we had the growth rate come down and so on and so forth. That's a problem. Now, what I'm going to introduce you to is a term, called GTM, efficiency, something that needs to progress moving forward, right? But I want to show you like how before I go there, I love for you to understand that, that when you win, like $1 every year, right? Let's say I down here, I close a deal $1. Next year, I close, that deal renews. I now have $2 from the same customer, one customer, okay? This is all the same customer. Customer closes one deal. Customer renews in year 2. I now have total $2 from the customer. Customer renews again. Thank you, Balut. I have $3 in the customer. Customer renews again. I got $4 in the next year. If the customer renews every year, after 5 years, I got $5. Nothing weird here, right? Like straight up, easy to understand. $1, one customer, 5 years, $5. If I have an NRR that goes up, in this case 109, and that is saying something, I'm going to get approximately end up at 5 years at $6. Now, what if I have to acquire that $1 in the beginning here in year 1? What if I acquire that at $1 cost? I spent $1 to acquire that $1. Well, I only acquired that $1, and look, at the end of the year 5, I'm making approximately 80%, 70% goes to sales and marketing if I accumulate that, right? In other words, $1 to get me $6. Now, what I want you to understand is that today, this is an oddity. This is rarely happening. What I want you to see is that $2 is a little bit more. If I spend $2 to acquire $1, oh my gosh, I still have to spend, if you look at the back end down here, and I will do some fancy flying, I'm going to go to the back end. Over there, you'll see that I still have to, at the end of that thing, I still have to spend R&D, which is product development, G&A, which is general and administration, and COGS. I still have to spend lots of money down here. So in order for all this thing to work, you'll see that with $2, it is already getting really, really hard to make money in 5 years. Ladies and gentlemen, I want to point out to you that today, and I'll show you and demonstrate you in a second, that the lion's share of the public SaaS companies are spending well in excess of $2 of acquisition. We're talking essentially that they're spending as much as $4 to acquire $1. Now, what that means is that I won't make money in year 5. What that means is I need to keep the customer for 10 years, 12 years, some case 15 years. That's the problem. That's what that's what an NRR and what GTM efficiency do. So it's very important for us is, hey, how much do we spend on a net new dollar? Because if that net new dollar then needs to stay with me for like 3 years to be profitable, for 5 years, for 7 years, for 9 years, you better have a fantastic product and a fantastic GRR NRR ratio, right? That's the mindset. And what we're seeing today is that is not the prevailing mindset. And I can, like renowned founders selling their companies at $1 billion are sending text messages, and I almost would love to let you read them, but it's like I'll say out loud what this person said to me. My team was woefully unprepared to go public. Not enough people put in the hard hours to learn the trade. This is a renowned, like if I tell you what the name is, like multiple multi-billion-dollar IPOs, writing my personal note to me. Revenue generation is the result of a repeatable process. And as we discuss what needs to happen, this is the fundamental problem. This thing is what holds everybody back. For that, we need a new approach. Now, I'm going to stop there. Diego, David, Andre, Nancy, give me a question. So I see David already has one up for me. What is to say SaaS is in puberty and not old age? Yeah, fair question. Is it in puberty? I think, David, because the business model itself should work. We have simply applied it the wrong way, right? And the way we have applied it is primarily to suit to the PE/VC interest, not to the customer interest and not to the business interest. The primary objective is to get the highest payout at IPO is what it's geared towards. What happens afterwards, most of the models is not, most of the CEOs are not familiar with that concept. And often I have to explain to a group of like 20 to 50 CEOs when they're in the room with me, saying, like, look, you're essentially here as cannon fodder for the one that is successful, right? But yeah, it is a fair question. Are we at the end? I don't think because the numbers, when you apply the business correctly, it is the most powerful business model that we have. And I say recurring revenue. That doesn't mean it needs to be annually recurring or monthly recurring. Consumption-based and usage-based and outcome-based is also considered recurring revenue. Okay, so it doesn't have to be all on a certain contract. What is different is the perpetual upfront paid software or the on-prem hardware. What is the next step for the company you modeled on the screen? What is the next best? This company that I'm currently have modeled on the screen is have a fantastic product. So you better make sure that that company holds for 15 to 20 years. Because once you have spent that money up front, you can't unspend it, right? Like you spend it. So a good way to do it, for example, would be to buy and acquire another company and increase the revenue, increase the NRR. So if the outcome is growth, then seeking IPO for, let me draw this into the screen so if the outcome is growth, when seeking IPO for a GTM, what would you say is the best outcome for using GTM strategy? Okay.
I'm coming with a question next.
Yeah. Oh, you go for it.
Cool. Yeah. So the one you have on your screen with this, it takes them $4 to get $1 back. Can you explain the differences between the growth at all costs era and now, when revenue multiples were 20x or like 50x for a Series B company versus now where they're getting 4 to 10 maybe, and how that revenue multiple basically puts a cap where they can't grow enough to raise the next round and down round. So while this behavior was acceptable to spend $4 to get $1 back in 2020, it no longer works because of the revenue multiples and financial situation.
Let me answer the question first. The previous one is before I go to and answer yours, Chris. So I'll give you a visual. This is a visual idea of what you see down here. This gentleman who grew in this glass bowl, this like virtual ecosystem that they he corked it and it lived for 60 years. It grew this botanical garden, self-sustaining garden. That is the capability of a recurring revenue system done correctly. And for the first 5 to 10 years, that's what happened. But then we started opening the bottle, so to speak, and we started to pour chemicals in and grow harder and started, but that is the goal. That is based on 3 things: revenue growth in a sustainable, cost-efficient manner, and based on a quality product. So companies keep buying more. To answer Chris' question, so historically, what you'll see, the nature has been that growth got overvalued versus cost. And we looked at that as if it happens once and it will continue to happen. But essentially, that is not the case, right? Like what I'm going to point to you is that when we look at growth, when we look at the balance between growth and cost, when you're at $1 million, Andre, are you capable of helping me out here? Andre, look, yes. Okay. Can you go off mute? Andre, how are you?
Good.
Andre, I'm at $2 million revenue. What is more important? How fast I'm growing or how much money I make, how much it costs me to grow?
How much it costs you?
At $2 million in revenue?
How fast you're growing?
How fast you're growing. Great. Sorry for the blues. I forgot to switch it up. Okay. And so how fast you're growing. Andre, and here's how that will work its way out. When you're at $2 million in revenue and there's a really big brand name that you want to close that will only bring you like $10,000 to $20,000, you essentially will go like, I hop on an airplane and I'm going to close that puppy, right? And so you may spend 5 to 10 grand just on the entire trip just to close that big brand name. You do that at like early stage revenue. But if you do that with 100 salespeople and you operate at $100 million, yeah, that ain't gonna fly, right? Like your expenses on travel are gonna go way out of berserk there. That's the mindset. The mindset here is growth and cost are favored to growth really early on in the sales cycle of growth, the S-curve. But later on, somewhere along the line, they start to change. It's a balance that starts to occur. Now, when that occurs is a conversation we can have. But I can tell you, when you're $2 billion, $3 billion, you probably should have a sustainable growth, like at that rate, right? So we know at 2 billion, you probably need to grow sustainably. And at 2 million, it's fine that you tinker around and you spend a lot. It's somewhere along the line that needs to go. Does that make sense, Andre?
Yep, makes sense.
Okay. And that means that during phases of growth, different rules apply. And as long as you now say, it's like, okay, where do we play the first rule? Now, if I recall it correctly, Chris, you said that they have gone through the growth model, right?
The revenue breakpoints.
Yes.
Yeah.
Okay. And so I'll briefly touch on how that growth model works, so you have like some context of why this is so important. I'll talk about 3 models. I'll first skip to the growth model, okay? And what I'm going to show you is that growth model, we historically say it has an S-curve, and the blue lines look to be a little phasey, but it's not the only, the S-curve is not the only growth line. It is just the way how rapid growth businesses have a tendency to grow. Tesla used a different line. Amazon grew on a different line. There's, Coca-Cola that I'm in front of uses a different line. But our industry, companies that you're part of, historically follow an S-curve. Now, that S-curve obviously follows this trend. And here you see some of the dots in the customers where we work with, where they are on that S-curve, right? A lot of companies, a lot of dots all around. I'll give you an example. This is Datadog. And so you'll see how Datadog grows. S-curve. Here's AWS, world-renowned companies. They follow that S-curve. We're in that industry, right? Now, what you'll see is that S-curve is based on 3 growth components. In the beginning, it's all acquisition, then retention comes up, and then eventually expansion comes up. The aggregate of those 3 forms that S-curve. What you'll see in the beginning, the first dot where we're going to cross, down here, you'll see that at some point in time, often 2-3 years into the existence of a company, the recurring revenue should start to exceed the acquisition of the revenue. It should grow faster on retention than it should grow on acquisition. And then you see later on the dot that follows, you'll see expansion start to exceed acquisition. Now, think about this and help me out here, or think with me for a second. If you're McKinsey, there is no Fortune 500 company that you can acquire. You already acquired all of them. If you're Adobe, you already know every, like creative person at every Fortune 2000 company. There's no more acquiring. All there is expanding, because you already own the entire market. You have every access to everybody. And that's why you'll see towards the end. Now, some people will say, it's like, oh my gosh, that means that that acquisition is not important. No, of course, acquisition is always important in some form or shape, but it's just other parts are also becoming important. Now, that tells us a few things. It tells us that we have these points that we're going through where things are shifting, creates phases of growth, stages of growth. And the first stage, is the startup stage. And in that startup stage, growth is super important, just like whatever it needs to get to $10 million. And then at the next stage, it's scale-up phase. Okay, we're now at 10. Do what works and do it efficiently. Make sure that we can scale it. Sustainability becomes an issue. And then we go into the next stage, which is the grown-up stage. Make sure you win the right customers, because we need to start making profit. So don't spend all your time on wasteful customers. And then lastly, you talk about, total available market. You're looking to expand the market. In other words, you acquire a different company, increasing profitability. You want to make sure that you're lowering your cost of manufacturing, and so on and so forth. In each of these stages, the point that Chris made is in a different balance. There are different stages. Now, Nick, how are you? I'm good, thank you. I didn't hear you, but I can read your body language. And so...
Great, thank you. How are you?
Oh, good. Thank you, Nick. Nick, hey, you went to elementary school, right? Tell me, when you went from elementary school to the next school, what do you call it in the US? From elementary school, where do you go to?
High school.
High school. Is there a big difference when you go from one school to another?
Yeah.
And when did you happen to go to university following high school?
I did.
Okay, tell me, what was different about going to university? How did you know that you went to a different school?
Well, the first thing is you physically go to a different school. That would be step one, right? Then the workload is more difficult. That's another thing, the amount of work. And then the focus, right? Where you're focused on, more specialization.
Absolutely. And having a son who just graduated from Cal Poly, he learned how to drink beer in university. That's all I can remember. Like I sent him like a kid who drank like soda pop, and he comes back and he's having whiskey and smoking a cigar. Like, what? Here. Okay. But when you go from one of the other, right, you clearly know this, right, Nick? It's a clear demarcation point. We do not have that with our stages. That's the problem. There is no clear demarcation point. There is no like, okay, folks, we end startup, everybody, let's go to training for scale up. We're now going into scale up mode. Doesn't exist. And so the entire group continues to act and behave as they are in startup mode. They even hire startup people. They even still talking about anti-process. They are hiring and so the mindset never shifts. There is no clear demarcation point. They don't know. That's the problem. And so several of the mindsets get stuck. And while thinking about it in one way, the next stage, the next phase actually works against you, right? Down here, this is all founder mode. Scale up is all about processes. If I don't get out of founder mode down here and into scale up mode, the company is going to run amok because, the founder is winging everything all the time fantastically, but there's no system and processes that can create repeatability and scalability. New product development, founder mode. Scaling an organization into 100 salespeople, that is a function of processes. 2 different stages, 2 different things. That's the mindset. Chris, does that help answer the question?
Sure does.
Okay, and so that gives you a little bit about like where this goes on. Now, what historically we've had an issue, and an issue that we historically ran into comes all down to the data model. Okay, and the data model that we have run into, all of you familiar with the former shape of the bow tie? If I point it up, but Chris, how familiar are they with the bow tie?
Most people are familiar.
The reason I bring that up because the bow tie for me, the statement I want you all to remember, keep that in mind. Recurring revenue starts where a funnel stops. That's the reason we can't have a funnel in. Right? And we need to start thinking about hey, how do we do that? You folks already know all this. Historically, we stopped at the close. When I grew up in sales, selling multi-million-dollar satellite earth stations, we moved to turnkey. That is like infrastructure, hardware, and today we operate on impact, forms of output, the forms of output generation. That's and the funnel never covered for that. And so we now needed the bow tie to cover for that. You all know this already. But the reason I need that is because where I'm going next. And where I'm going next is the creation of the factory. In order to create a factory, help me out here. Kelsey and David, help me out there. Type in the chat. What are the goals of a factory? What are the main goals of a factory? Operational efficiency, love that. Production at scale, number 2, love that. Both of them, Rihanna and predictable, love that. Efficiency for profitability, love that. Durability, thank you, Nick. Consistency, okay. Rihanna, you type in consistency. What is another word that predictability and efficiency? Consistency is one thing, but what is a different word that relates to consistency? Why do I want consistency? Consistency in what? Quality. Thank you, Sky. You already passed, so I can't see it anymore. Thank you, Charlie, and thank you, Sky, whoever was. Okay, those are the 3 goals. I want to produce. So a lot of production. I want to do cost efficiency, and I want to deliver a quality product. And by the way, that 3rd thing is only with us because otherwise companies would run amok. Because if you wouldn't add quality, we get all low-cost production, and that has happened for a long time. These are the 3 things. Now, help me out here. Production in a revenue factory instead of a regular factory equals what? Production is what? Growth. Thank you. Okay. Well, easy one, but what is it? Cost efficiency equals lower cost. It's a word that we use in the industry right now. Let me not suss you.
Go to market efficiency.
Market efficiency, GTM efficiency. And that's a form of, and then last one, quality equals what? Diego, Charlie, Tracy, impact from recurring. Thank you. Okay, how do we measure? How do we measure if something is successful? What are the 3-letter acronym that we use for that? Retention metrics. Yeah, which one? ROI. Yeah, Nancy, not bad. Yeah, that's okay. I'm gonna give it to you. NR, GR. Give me just to you, everyone. NR and GR. Those are the 2 metrics we measure. So now what we have, growth, we measure that in growth rate. We measure, quality in NRR and GRR, and we can have a long discussion which one is better. I'm completely ready to have that conversation one day, not today, but one day. What is better as a measure of quality? And then the last one that we're missing is we skipped over this entire thing called sustainability. We've never spoken about it. And that is what we see today. That introduces us to GTM efficiency. Now what I'm going to show you what GTM efficiency looks like. Okay? GTM efficiency is the adjusted sales and marketing spend. What do I mean with adjusted? You look at a company's balance sheet, you take whatever is behind sales and marketing, and you extract from that any compensation-based, any stock-based compensation. 99% of the case, this doesn't matter, but for us in public companies, a lot of salaries are deferred till the company goes IPO through a stock-based comp plan. So just let it know that Dave Spitz, who did this from Benchside, know what he's talking about, and he made sure that we remove that sales and we remove the stock-based compensation. We divide that by the last 12 months net new. LTM stands for last 12 months. So I average it over the last 12 months, meaning that any seasonality that occurs during the year is averaged. So the summer and the winter, right? Summer months, it's all average. So it helps each other out. Now, what you're going to see, I'm going to create here GTM efficiency and say, whether the term is right, which is up for debate, let that be for today, not the conversation. Is it if I take $2 in order to acquire $1, that is called 200%. Okay. If I take $4 to acquire $1, that is 400%. So whether you want to call that 4x, 2x, and so on, 400%, know that whatever that number says, it is how much you're spending on acquiring it.
I think it's super important to clarify at this point, in both the acquire net new logo acquisition, but also acquire revenue via expansion. So GTM efficiency, the main difference here regarding CAC payback, which is used in new logo, is that it combines new logo and net new ARR, less contraction and churn. So that's the big difference here, because people are like, oh, this is the same as CAC payback period, but it's actually very different. It includes the whole right side of the bow tie as well, and all the costs that go into the post sale, which is generally not considered in CAC payback.
Brilliant. And to make sure that what this means, and I know that, Chris, I was thinking you were going to go there as well, because you and I are always agreeing on this. Up and to the right, therefore, is not good. Think you don't want to go up and to the right here. You want to go to the right and the low. You want this cost to come down, not to go up, right? Now, while we've measured this over the past 5 quarters, or since Q1 of 2. And again, every quarter is the last 12 months, right? So the last 12 months that ended in March 2023, the last 12 months that ended in June 2023, right? Think of it that way, so that we average it always over that cycle, right? So that shows you how robust this number is, okay? You're going to have, in a second, you're going to have an eye-popping experience. I just want you all to know that you go like, holy smokes. Okay, here are the companies that are in that. Okay, now we assume for the time being that $2, it is what it is in the market. Where it would be it would be below $2 would be fine. Over $2 would be challenging. Over $4, this would be problematic. Here is the not top performing, but second tier performing companies. And so you see Salesforce is hovering around $3. You see Asana down here, and so on and so forth. Now I'm going to hone in and give you an explanation here. We see Smartsheet was operating at about $2. Where am I there? There was operating at $2 and is growing. It's quarter over quarter, it keeps growing. Mind you, these things can fluctuate very quickly unless you lay off a lot of people, right? Next one up. If I look at Salesforce, see how it stayed flat. Now notice that Salesforce stopped spending a lot. Guess what Salesforce just reported a few weeks ago? What did they report? Chris, do you know what they reported?
I don't know.
They fell below 2 digits of growth to 1 digit of growth. First time ever they fell to single digits of growth. Why? Because they stopped spending on the growth. Lots of losses. There you go. Thank you, Kevin. You got it. And so you'll see. Now, I'm going to show you another example in a second, and I'm going to do Dropbox. Dropbox was having low growth. They were in the single digit growth. And like one of the clients we work with, and what we see is that, hey, they said we can increase our growth because they were relatively low at $2, but with the billion, they go like, okay, let's rev the engine a little bit. And then you got Model N spinning completely out of control. And what happened to Model N? Got acquired. Right? Like, so now you may want to say, Jacco, if that is what unhealthy companies look like, what does healthy companies look like? This is what a healthy companies look like. It can be done. Here you see the familiar names: Atlassian, Datadog, CrowdStrike, Snowflake, ServiceNow, Klaviyo, and so on. Here you see all, folks, it can be done. It is a disciplined approach. You need to have FP&A as part of your executive team. You need to have your CFO as a member of your GTM team. When you do that, that's how you end up. Go ahead, Chris.
I'm just agreeing with you. Like FP&A and finance need to be part of GTM.
Right? And the one that I'm not showing publicly, but will do on this specific group. Are you ready? I'm dragging it in. Here it comes. These are the unhealthy companies. Okay, let me see if I zoom in a little bit. These are the ones that I'm trying to hide as much as I can when I'm on stage, because there's always, okay. And these companies go well over $4, right? And now what you'll see, you see the Zoom infos and going into the $6 range. Okay, Zoom info and Zoom have catapulted, and so we start to see that is completely like out of control right now. Now the point here is that like this is not just happening in the public SaaS company. This is a reflection of what we see. When I said earlier to you folks, we help these amount of companies. It was not just to brag about how great we are. It helps me to validate. We see this in the 100+ companies, and we see this in the 1,000 companies. This thing is an industry-wide thing. This is not like, oh, I'll grow out of it. No. The problem is, if you don't operate it at $100 million correctly, it is because you didn't operate it at $10 million correctly, and that means you're not going to operate it at $1 billion correctly. That's what we have seen again and again. So think about the following. We already know that a revenue factory grows like a factory, right? We already know that. Now, my next topic is, what if this is not only excluded to the goals? What if actually it matches to other things that we're seeing? What if it matters and applies to every part of our business? Okay, what I'm going to introduce you is to the concept of what we can learn from factories. Okay, let me look. There we go. Now, I'm skipping through this a little bit here and there. We already know the goals of a factory. The goals of a factory are volume, cost efficiency, and product quality. We already know scalable growth was growth rate. We brought durable growth in, and we brought sustainable growth. And here you have the terms that you're familiar with. Scalable growth, can I ramp the revenue up? Sustainable growth, can I do it cost efficiently by bringing my cost down? And durable growth, can I make sure my GNR and NR is effective? Number 2, fundamental element of your operation is that an input results into an output. More prospects lead to more output, which could be growth, could be efficiency growth and quality growth. What you'll see is I got 2 metrics. More volume, I increase the input goes up, output goes up. Okay? I also have throughput if I make the performance better. This mimics a factory line. I can put more inputs, I can put more, melted steel, and then the factory can produce more, bolts or whatever they create out of that. But it has efficiency to do. Again, early on, a company grows through inputs. And more inputs is what we grow at all cost. Give me more inputs, give me more inputs, give me more inputs. And the throughputs is what we don't focus on. That's where cost efficiency comes from. Now, what you'll see if I open that box, what is in that box? I'm going to see historically, from the nature of factories going back to the 1950s, Deming, it comes back to 3 things: process, systems, and people. These are not unknown. These are not like things that we have never dealt with. These are exactly the things we've always dealt with. What are we dealing with? Process. Our growth and growth at all cost process has upended itself. Systems, AI are coming in like robots and replacing human beings. And people, Folks, we're dealing with a post-COVID unproductivity, undisciplined execution from process level that we have never seen before, right? And I can give you the metrics on that. This is not like, oh, this feels like, are you against millennials? Has nothing, well, has something to do with millennials, but it has to do with every person in every age group bracket, every dimension is underperforming. And so what you'll see here is it all comes back to those same things. That tells us that if we look at what really is happening in factories, that it really applies to us. If we look at what the operational backbone of a factory is, it is, on the left, machine production, high volume, no touch. And on the right here next to me, you're going to see no volume, high touch production. You're going to see that this is quite normal. You can actually see that they are dependent on the same things. Heck, folks, this maps perfectly to PLG, enterprise, SMB sales, same thing. High volume, no touch, you would do all that PLG. No volume or low volume, like no volume, high touch, you call that enterprise sales. And we call it no volume because in the world of production, winning 100 deals a year is no volume, right? Like that in the world of production that looks this big. And in the middle, you have your SMB sales, low volume, low touch. So the goals of a factory map, the way that process systems and people map to a factory, the way AI is replacing and doing the same. Where robots is saying, folks, we are literally talking about a factory. By the way, where we go next, I can explain to you. Over the next 2, 3, 5, 10 years, whatever it is, we're going to get a quality standard. If you think the agile for software, design thinking, TQ, man, all that, we are within a mere, strike away from that becoming an issue. Folks, Six Sigma has already improved manufacturing. Agile has improved software development. Lean management has improved factory and production capacity, or shipment capacity. People say creative processes such as sales cannot be improved. Design thinking has applied it for that. Folks, an orchestra works of it. I can go on and on and on and on. We're the only vertical of significance that does not have a form of quality management. And this will exist within the next 5 to 10 years. It will become a thing. It will become as normal as a thing as we now talk about agile software. Is agile moving on from or our software teams moving on from agile? Absolutely. They're going to the next generation, right? But that tells you what Chris is talking about, because what I'm now going to do next is I'm going to show you how we're going to turn that, and we're going to turn it on its head, and we're now going to look at what I said a second ago. Sit back, relax, and enjoy as I show you how we're going to take that model now to the GTM model. The GTM model's primary focus is to align the cost of production. What is this manufacturing line producing? What is the cost of this manufacturing line? And match that up to the cost of revenue acquired, retained, and expanded. In order to do that, I got to go back to the bow tie because I got to use the data model. I got to go, where am I measuring this? The funnel won't do it because it doesn't cover the entire thing. And as Chris and I just said to you, it's like, hey, the expansion, which sits on the right side of the bow tie, is also super important. And by the way, folks, I know that this is somewhat academic, but at the same time, I go like, this is an opportunity. Like, man, we are not just opinions. We are not just based on good feel and salespeople with a savvy talk. This is mathematics and calculation. This is like designing bridges, right? This is like building 10-story apartment complexes, right? You'll see what I'm now going to do. I apply a process to each of those. And on the left, lead development process, lead generation process, sales process, the onboarding process. I just map that to each of those. I'm going to simplify that, call it marketing, sales, and customer success. I know it's broader. I'm just keeping it simple for everyone, right? I'm going to map that and say, at the $10,000 price, most likely I cannot afford a $350,000 salesperson to sell a $10,000 product. Or PLG companies will not sign on the dotted line by getting an automatic payment reminder or a credit card transaction. They have a different methodology. So what you'll see, and I'll make the picture complete. Today, we see that there's 5 production lines. There are 5 different production lines that produce and generate revenue at a different cost center and at a different volume of production, vertical axis, and at the cost of production, horizontal axis. These 5 production lines are known And David Skok in 2010, 11, 12 already mentioned these at that point in time, right? Yeah, this is a lot of finance, sales, marketing in many companies, but it does not move to be treating. Let me help. Donna says this. There's a lot of finance, sales, and marketing in many companies, but it does not move to treating GTM as one aggregator approach. That's right. That is the problem because nobody's responsible for it. If I ask all of you, who is responsible for GTM right now? Who's responsible to map all this, right? And then what you're going to come to the conclusion is like you're going to find is like, it's the CEO, but the CEO doesn't know this, right? Oh, it's the CRO. Yeah, the CRO primarily wants to grow more because they are based on a comp plan that's structured that way, right? Like, and in most cases, the CRO is nothing more than a VP of sales who got promoted so that they could, get more revenue from customer success. And by the way, that may be the right future model, okay? I'm not saying that is wrong. I'm saying as long as it plays the anticipated role within it, right? It shouldn't be the only role. Actually, customer success going back to sales is a trend that we can see is well worth the discussion. Folks, what you'll see down here, by organizing and structuring these factory lines, like here for high touch and making sure the field sales organization has a targeted ABM campaign and that your customer success team is mapped by segment rather than by volume of deals. And that if you run an SMB style business, that you are most likely will continue to use an SDR AE style organization. These are things, and particularly in vertical SaaS, these are things that we know are as true as that the fact that at $100 an annual sale, you're going to be dependent on PLG. I mean, like you're not going to use an expensive salesperson to sell a $100 annual subscription, right? These things help us create and start to see that there's three models. Those models that we today are presented to you down here. There are the first three models of the total of 6 models: data model, GTM model, and growth model. The more models you have, the more accurate it becomes. The same way that the bone structure itself will not explain to a human being, its bone structure, like the physical skeleton, when you look at it, it doesn't tell you how a human being propels itself. You need the muscular system as well. And you need the cardiovascular system as well to see how it all operates. The same way, these three models tell you how revenue growth is happening. We'll have a class of customers go up. Okay, let's go.
Okay, let's go. Let's some Q&A.
Doug's got some questions. Unmuting him.
Hey, Jacco. Thanks for coming, and Chris for hosting, and team is really wonderful and refreshing. So I was curious about the generators, the rev gen folks, the ops folks, the marketing folks, what they should be doing today to position themselves to be relevant for the current and future environments that are currently overrun by the VC and the PE folks that want to use spreadsheets all the time. What do we do?
I think first and foremost, Chris, I think you need to, if you think about people, systems, and processes, that is language that VCs and PE firms also know very well, right? My suggestion is get familiar with revenue architecture. And the key thing down here is unit economics. Learn to communicate in unit economics. Folks, I can generate, one win at a 10,000, that brings us $10,000. But it will take me like 5,000 leads to do that. And the cost in order to get me there will cost X. With an average GRR of Y, we are going to get this amount of money. Are you sure you want to have that conversation, right? And if the VCs and the PE says, absolutely, we'll fund it. And the CEO says, yes, I'll gladly give my company away. Yeah, what can you do? But that's the conversation. Communicate in unit economics. We call that the growth formula, but unit economics is the term here. Thank you.
Nancy's got a good question. Bringing her off mute.
Nancy, how are you?
I'm good, Jacco. You and I actually exchanged the email about a month ago over Belkin's podcast. So if my question needs to be taken offline, I can email you later directly. So my question is this. I know today's session was directly relevant to SaaS businesses. However, just looking at your GTM model, the low touch to high touch, maybe just think of a current client I have, which is in the B2B e-commerce space, a $40 million business. what that specifically means is they sell industrial automation refurbished in new parts for big machineries like Allen Bradley, Siemens type of industrial automation machines. I wanted to know if your model is relevant to that kind of business.
It is. The model is only limited by the following. Or let me say what it is. These models cover anybody that needs to win a customer again and again to hit their financial targets. If you hit your financial target on the first purchase and you never have to deal with a customer again, then that is a more perpetual or an on-prem style model that works, right? But anybody that needs additional sales. So we help companies. There's a very famous one that we cannot mention, but that brings satellite terminals to everybody's home and mobile RV and boat nowadays. They make money, but then they need a company not to only buy one of those terminals, they need to buy 500, 1,000, 2,000 terminals, right? And we deal with the B2B, not the B2C part of it.
However, I would say highlight the one little caveat that made me question whether it's relevant or not is the nature of this B2B e-commerce, because they're selling refurbished and new parts. 56% of their monthly orders are from new customers, and 100% of their go-to-market motion is PPC.
Yeah, like I said, if the business is very based on retention and expansion, then it works. If the business is not very dependent on retention and expansion, then these models, when we have to go back to the more, close a deal up front, get the highest sales price and send the customer. But from the sounds of it, it sounds well.
Okay, I'll follow up separately.
Thank you, Nancy.
Thank you.
Let's try to get one or two more and then we'll close out a couple of minutes late.
I have been brought off mute, so I guess it's up to me. Hi, Jacco. It's a pleasure to talk to you again. So we have a factory analogy. So a lot of automobile companies are overproducing. They're scaling back on production because there's overproduction based on what the market can bear. Do you see that as a potential impact where we have too many factories producing somewhat similar stuff for a market category? And what happens there? So you've been talking about producing. There's the other side. There's the demand side. I'm just asking a bit about the demand side, I guess.
No, actually sustainably producing, but because you're spot on. If we go back, right, and we go back to how many car manufacturers there were in the late, I think, 1920s, 30s, we talked about several thousand of car manufacturers. And today, I think they call it the big three, but let's call them, there are 10 total car manufacturers worldwide or something like that. We're going to see the same happening in our world. We have 36,000 plus SaaS companies, David. We anticipate there will be, many fewer. Now, whether vertical SaaS will spin a whole new generation of SaaS companies up, that can be determined, but they will not be valued at billions of dollars, right? The next generation of SaaS companies will be vertical SaaS companies, will be valued at $100 or $200 million. Not everybody needs to be valued at X billion dollars. Those companies that we already see, Drift got acquired by SalesLoft, and so on. Tatango acquired Catalyst. We're going to see that over the next 2 years, a lot of that. Because those companies that geared up to IPO that don't have a place to go need to either merge and acquire with one of their competitors. And you're going to see VC and PE firms driving that every day in, day out. And we already see lots of that activity going on. But yes, the market, we have too many providers for too small of a demand. You're absolutely right.
All right, folks, we're just going over time, but if you have time for one more question, I can throw one of them in from the chat.
Let's do one more and then we'll close out.
Well, so this one is from Casper. The question is, how can inefficient companies stay alive? Is it due to investments and funding? Any tips that you have on this would be good.
Absolutely. Thank you. Sorry, I'm already like chomping at the bit, Karen. I'm already interrupting you right as you didn't even finish the sentence. You're like, take it, I'll take it. Okay, here's the thing. Over the past 10 years, the primary role of a CEO founder was to secure funding. Now, historically, those funding were from customers, but then due to the VC world, that funding primarily came from VC and PE firms, which is perfectly fine. There's nothing wrong with that, right? It's just the terms that they came with and the valuation that rocked the boat. But now the VC and the PE money has dried out, and for many, it will dry out for two reasons. The markets are getting smaller, There's lots of SaaS companies selling to SaaS companies, and therefore your market is shrinking because fewer and fewer SaaS companies are there, fewer seats. And that's simply because we overbuilt the entire thing, like David spoke about a second ago, right? Then the second thing is, folks, I want you to understand, AI has another primary impact. The other primary impact is sucking venture capital out of the market right now and applying that. And just mentioning that your product can do AI doesn't make you an AI company, right? I'm talking about companies launching their previous round expansion funds and are starting to think about investing, pulling that out of their fund E and F and G and pulling that into a new round called H, because the multiples on AI, native AI company is so much higher. What that means is that the CEO founder of what we call a Gen 2, Gen 3 SaaS company. Gen 1 is Salesforce and the like. Gen 2, think of that as SalesLoft and Gainsight and so on and so forth. Today's companies that are in that category, not gone public, but are a SaaS company with revenue, you have to make your revenue from customers. You have to get your funding from customers. Like that means that we are advising our customers, like get your payment terms correct, increase your price, get more, if appropriate and when appropriate, and it's not always, get multi-year contracts paid up front. Like whatever you can do, if you're a struggling SaaS company, get the cash, and make sure that you run your business as if you're the CEO of a business that is a mom and pop shop that you're living paycheck to paycheck. That level of mindset is what we're looking to change. Based on Carta data, I'm looking at the remarks, and in order to wrap it up, based on Carta data, more companies are exiting at seed and A rounds than B rounds. There you go, right? We are seeing that this is happening right now. And thank you for David for providing that stat. And it's a stat that you can Google and find. With that said, Chris, handing it back to you.
Hand it back. All right, everyone. We could have sat here for, I think, 3 or 4 hours and gone through that. That was really awesome. Thank you for joining and sharing that with everyone. I can speak for the people in the crowd. I can imagine they got a ton out of it to take some of these concepts and to the next level with you. So really appreciate you joining and sharing with us. I'm sure everyone else is happy as well. And for everyone, we'll be back. We're actually having David Spitz on the show in 2 weeks. So David will be sharing some of the benchmarks and the go-to-market efficiency data that Jacco shared, and we'll be discussing that in more detail, and maybe even bring a couple more FP&A and finance people into the Unified Go-to-Market live show. So that's on September 24th at 12 p.m. Central. Jacco, thanks for being here. If you have anything to close out, just let me know.
Look, I love the partnership we're building together, Chris. I love the fact that, Winning by Design really is looking to establish itself. We create some of this content. And Chris, you're a person, a bridge, a person that can bring this to your community, help your community with this. So whatever we can do, and I'm looking forward. We're just at the start of hopefully a very, very long partnership together. Looking forward to you sharing your knowledge and expertise and tuning it up so your audience can digest this the best way that you see possible.
Same here. Looking forward to it. Thanks, everyone. We'll catch you back here next week, every week, Tuesday, 12 p.m. Central. Thank you.